A weak economy, I'll use the linkages. This is Economics 101, and I'm sure everybody listening to this can understand it. That's not being patronising, it's just being a fact. When the economy slows down, which it is, slows down a lot, what happens to the business sector? They say, oh, no one's coming into my shop. No one's using my transport. They're not delivering as many goods because people are cutting back on their spending. Therefore, I don't need to hire as many people. Therefore, the unemployment rate goes up. Therefore, when you lose your job, you earn no income by definition. You might have been earning money doing whatever you're doing. You're unemployed, you earn nothing. So you stop spending. So you get this circularity in the economy where the initial weakening in GDP, in the economy, feeds through into a higher unemployment, feeds into lower spending, feeds into even weaker economic activity. And we're in the middle of that cycle now. It hasn't come to an end. And that's the thing that concerns me and got me a little bit hot under the collar earlier this week, that we have not got to the end of that cycle. Unemployment's gone up, from 3.5 to 4.1%, so it's moving higher. Because we know job ads are down 27%, so firms are not hiring anymore. Or they've cut back their hiring. And if you don't hire, you don't get a job, you don't earn income, you're not adding to output when you're working, because when you're working, you're adding to economic activity. And that's where I see significant, if not huge, downside risks to the economy in the second half of 2024 and probably into 2025 as well.
Okay. I mean, in those places I just said to you, the reason they are dropping interest rates, Canada, UK, and ECB, but they just missed an interest rate drop, but they have done one.
Yep.
Their inflation is really low. It's low to mid twos.
It's come off dramatically.
I'm just saying, is the correlation between a much higher unemployment number and a much lower inflation number, which is what we end up having in the 90s, is that something that's unavoidable? I mean, because
to an extent it is, and indeed, that's why the RBA is not, the RBA, unlike these other central banks around the rest of the world, are not cutting interest rates. In fact, signaling they're not going to cut them, because they are saying, and it came out in their forecasts earlier this week, that the unemployment rate is still got to go up before they're content.
Correct.
That they've got the big picture economic conditions in the right place to get inflation back to target.
Okay,
now,
let me ask you. Did she say that in her statement? Because she did. I think she said that. She made a comment about unemployment still too high.
Yes.
Too low.
Too low. Yes, the labour market's too tight or whatever.
They were worse. She didn't say what you're not. It's code.
we can say it.
Yeah, and we are saying it. I'm going to call it out.
Yep.
And that, in relation to her statement, you and I have talked about this ad nauseum. Every meeting we talk about the 4.5% that she's already declared in their modelling that they did in June last year, and it may well be revised. It could be higher for that matter. It could be 5. I don't know. She hasn't told us. Wish she would tell us. Come out and tell us, please, Governor. Tell us what is the unemployment number you think is the appropriate number for us. You think modelling will get us to the inflation number that you're telling us we have. You're telling us we have 2 to 3%. Righto. What do you reckon unemployment is going to end up at? Where do you think it's going to go?
I'm worried we're heading towards 5%.
Me too.
Touched on sort of the difference in composition around the consumer. There's been some discussion recently about the generational differences in terms of how people are spending, particularly older generations, baby boomers, relative to maybe younger generations, and their spending patterns and how they're seeing the world and the economy, etc. Are you seeing anything in that regard in the data?
I think it's more, really the way we're thinking about it is more a composition of what might be happening to your income and what's happening to your outgoings and what that means in terms of your capacity for spending and then the choices that you make. I mean, and everyone, we all have our household budgets. I know I have mine, and the bills come in and you work out what you've got left and where you spend and what you save and things. But what we're generally seeing is that if you're in a position where you don't have a mortgage, for instance, and you own your own home, then you're not really impacted by rent movements, you're not impacted by the increase in your mortgage each month. And so for you, that group maybe got a bit more space in terms of their spending. Other groups that we can see are impacted by those things. You might be a renter and you're seeing a significant increase in the rents when your contract is renewed, or if you're carrying a mortgage, then you might, over the last couple of years, you probably have seen an increase in your mortgage repayments, and so that then constrains your spending perhaps a bit more on other types of items and products. So it's more that products of circumstance that we're really tracking and thinking about the how many different households fit into each group and the decisions that individuals make. So we know it's tough for some groups, and we're really mindful of that. And we know other groups perhaps not as impacted, but everyone's impacted by high inflation, and that's a really good reason for the board and for us to be very focused on it.
The Reserve Bank. So the mandate of the Reserve Bank is to contribute to the economic prosperity and welfare of the Australian people. And the way we do that is by trying to deliver price stability and full employment. Now, what does this mean in practice? Well, in practice, it means setting monetary policy to keep inflation between 2 and 3% and employment at the maximum level that's consistent with maintaining low and stable inflation. And the way we achieve this is by setting the interest rate on overnight loans between banks, and we call that the cash rate. And that cash rate influences interest rates in the economy. So it affects borrowers, it affects lenders, and through that, economic activity and ultimately the rate of inflation. Now, that all sounds quite straightforward, I'm sure, but it's actually very complex. It involves the board assessing current economic conditions, and then they have to forecast how they think the economy is going to go over the next year or so. And then they need to consider the risks and trade-offs associated with that, because nothing's certain. Forecasts aren't certain. And then they have to decide, well, given all that, where will we set the level of interest rates? What level of interest rates do we think is required to deliver an inflation rate of between 2 and 3%, while at the same time keeping the unemployment rate as low as possible? And I think the experience since the pandemic has demonstrated just how complex this can be. Is that working? No?
The RBA is playing with fire, and just as another aside, and I don't mean to go back over the 2021 Dr. Lowe when he was governor, no rate hikes for 3 years. But I remember, and I was actually looking at this earlier yesterday, because I was just sort of, what did they do back then? In late 2021, inflation spiked up. Again, it was seemingly temporary. The markets, the bond market, the money markets were pricing in 6 or 7 rate hikes. The RBA governor, Dr. Lowe, came out and said, oh no, we think this inflation is a blip. It's going to stay low. We're going to keep interest rates at 0.1% for the next 3 years. And money markets are wrong. Fast forward to today, the RBA governor said, it's a 180-degree reversal. She said, we think inflation's going to be persistent. It's not going to fall quickly.
Oh, and she actually said 2026 before we get to the range.
Yes, before we get to the middle of the range.
So they've extended the period.
Yes, they put it out another 6 or 12 months.
Yeah.
Yep. So, we don't think inflation's coming down quickly, unlike every other country that you just mentioned before. And she was asked about, markets are pricing in rate cuts before the end. This was before her speech. By the end of 2024, they were pricing in a 25-point cut by December. She said, the markets are wrong.
That's scary.
And that worries me because having worked in markets and speak to people in markets every day, money markets are driven by people investing billions of dollars in government
with
bonds.
All the information.
And they're smart people. And they're sitting not just in Sydney and Melbourne, they're sitting in Frankfurt, Tokyo, New York. Global investors buy the Australian bond market. And so I'm thinking, this is not meant to be a rude comment about the RBA, who are full of PhD economists, absolutely smarter economists than I'd ever dream I could be. But the weight of money is telling me something that the RBA doesn't get. So Dr. Lowe made the mistake 3 years ago. Markets are wrong. They're pricing rate hikes. No, we know better. We're the RBA, and our models are telling us that inflation's not going to go up. Now, there's enough of the market saying inflation's coming down. RBA, the inflation rate's coming down. Yeah, look, we might want it to be there tomorrow rather than in 6 months, but I think their inflation forecasts are wrong, just like they were 3 years ago. And to say the money markets are wrong, and even despite what she said, Mark, I was looking at the curve this morning before I came in to record this. The chances of a rate hike, according to our futures market, is a big fat 0. We are still pricing in a rate cut, but not until February. But the cut is still there, and a couple more cuts after that are in the money markets. So the money markets have said to the RBA governor, "You're wrong."
Well, that's probably quite a critical point.